And now we'll go to Representative Barrow's bill, House Bill 5793, Small Loan Lender. Representative Almeida, are you present? Would you like to come forward with your bill, House Bill 5553?
Thank you, Madam Chairman. I would like to make a few comments on Bill 5793 and maybe a little history about this particular matter. Bill 5793 by myself is a people's bill that seeks to restore the usury cap to 36, APR over time. This would allow us to be more in line with the federal law that was enacted back in 2006 to protect military families from being victimized by predatory lenders. Rhode Island has had a cap of 6% when we were still a colony because the founding fathers understood the threat and wanted to protect our citizens then and now from predatory lenders who are now charging our Rhode Island citizens upwards of 260% APR. Rhode Island had a cap in place up until 2001, until the PayDay lenders obtained a special deal where they were exempt from the small loan laws. In 2002, the General Assembly created a bill that allowed these predatory lenders to charge upwards of 260% APR. In 2005, the General Assembly went again even further in allowing them to charge 280% APR. I'm not sure why, but perhaps they were not making enough money at the time, so we allowed them to to get more money off the back of Rhode Island taxpayers. In 2011, some of people here might remember there was a compromise bill, Bill 5834. It was agreed upon and was scheduled to be voted on the floor, which this bill would have reduced the APR from 260 to 130. However, at the last minute, Bill 5834 mysteriously disappeared from the floor vote without any explanation, despite the outrage from many General Assembly members. I suppose that the greedy PayDay lenders organization with their big bank accounts decided, instead of going along with the compromise bill, which they were a party to, that decided that through their lobby, that they would deny the people of Rhode Island the opportunity to have that bill heard on the floor that day. All of what the General Assembly has helped to facilitate for these PayDay loans since 2011 was and is in sharp contrast to what is happening with our neighboring state and nationally with regards to PayDay lending. Since 2005, no new state has legalized PayDay lending. Rhode Island is the only New England state that allows its citizens to be charged 260% APR on a 2-week or less loan. In July of 2014, Ace Cash Express agreed to pay the U.S. Consumer Financial Protection Bureau $10 million in fine because they used false threats, intimidation, and harassing calls to bully PayDay borrowers into a cycle of debt. I'm sure that we will hear testimony today on how vital these two lending organizations are to the state of Rhode Island's economy. They will blame the borrowers for the industry's greed. They will talk about job loss and the ability to access short-term loans of 260%. I suppose that's their claim to fame. However, there's been many studies, one in particular done in 2011 by Insight Center for Community Economic Development, stated that the net economic effect to Rhode Island was a net loss of about $1.6 million, not a gain, by the way. I would urge my colleagues to consider the facts and reasons why these predatory lending practices are not allowed in our neighboring states. It's bad, it's wrong, it hurts people, it hurts our people. None of what you will hear from these organizations today will benefit the people of Rhode Island. This is why, since 2005, no new state has legalized PayDay lending, and that we are still the only New England state to allow our citizens to be charged this outrageous fee of 260% of APR for a 2-week loan. These PayDay lenders do not care how their predatory practices victimize our citizens, but we, who were elected to represent and live in these communities where they are allowed to set up shop know the damage that they are causing to our citizenry. In closing, Madam Chairman, in the General Assembly today, we have been talking a lot about being outliers and about on various budgetary issues. However, this is an issue that does not cost us much, but yet address an injustice being perpetrated by this organization for far too long. We have been an outlier on this issue for nearly 15 years, and today we have an opportunity to reverse course and catch up to our neighboring states. I feel that if we do not address this issue now, that we will be seen as putting the interests and greed of these predatory lenders over the interests of the people who elected us to represent them. We can decide not to be an outlier any longer by following some of the best practices from our neighboring state, by allowing these predatory lenders, by allowing these predatory lending practices to go on one more day is doing a disservice to the hard-working, tax-paying men and women of the state of Rhode Island. Thank you, Madam Chairman.
Thank you, Representative Barrows. Representative Almeida.
Thank you, Madam Chair, and good members of this committee. My colleague just gave you the numbers where it's at, so I guess my part is to give you the heart and soul of all this. And the heart and soul of this is this bill's been around for quite a while. There was a comment that was made many years ago, and it was, if you want to get rich, just suck it out of the poor, because they'll pay. And that's what's happening in a lot of the urban areas. And because of that, the financial crisis or the inability of the families to live from paycheck to paycheck or cash to cash, they understand that. So they just keep rolling these checks over and over and over again. And it doesn't stop. When I was here many years ago, I presented it. Former Representative Frank Ferry did a great job with getting it this far. But we're always talking about this being the house of the people. Which people? Because my colleague and I are here to talk about poor people whose checks simply get sucked out from 260 to 280%. I'm thinking it's about 280. Frank Ferry did a great job. You're about to hear from some of the people that's going to talk about this. With this, I'm saying to you all that if this is the house of the people, then listen to the people. Because we got a long list of supporters of all different organizations that are saying this needs to stop and there's got to be a better way to do financial budgeting or, in fact, stop sucking the money out of the poor. So with that, I'm here to answer any of your questions.
Thank you, Representative Almeida. Representative Giarrusso.
Thank you, Madam Chair. I guess this is a question for either one of you. Do we have any idea how many people are in financial straits with this? Now, I can see how the domino effect will work. I'm just wondering if we know percentage of these people or the number.
I think we should leave that question, sir, with great respect to the professionals that's about to come up here, because they got all kinds of statistics that will show you. I got a number, but I might want to give it to you because I don't want to mess up their testimony. All right? But the fact is, it's a large number.
Now, also, you mentioned that Massachusetts and Connecticut doesn't have the same practice that we do. So, in your opinion, why do you think we allow it? I mean, who's holding this thing?
We would say would be some of the big business. I think, was it Walmart? Some of the big check cashing places. I can't think of all their names right now. Advance, was it Walmart? There was a whole bunch of them. Knowing that poor people would come and pay, or they had the ability to keep flipping that check over and over and over again. So who are we looking at? Some of the big businesses.
Yeah, I would, to go back to your question, Representative Giarrusso. Yeah, I think the people who are actually perpetrating this is the two main predatory lenders in the state. and they're the one with the deep pockets, and they're the one that keeps lobbying really hard. I mean, obviously, we had it to 260. They lobbied really hard to bring it to 280. And if we keep allowing them to do this, they're going to lobby it to 390. So, I mean, this is something that we really can't do.
So we should stop lobbying, I guess.
Yeah, that's it. We should stop them from lobbying us.
Thank you, guys.
Representative Morgan.
Thank you, Madam Chairman. Thank you, gentlemen, for bringing this to our attention again this year. I've actually witnessed the devastation these payday loans have on people's lives, and I really think that they need huge reforming. Your bills do away with them the practice totally.
Well, I think our bill basically seemed to bring it back down to a more normal, to a level that I think is more acceptable. In this case, I mean, the 36% APR.
To 36%.
Like the federal government has for the military families. I mean, because obviously we just heard from the military court. I mean, obviously they're doing it because they understand that this is a problem. I think we understand it's a problem. I think as a body we understand it's a problem. I think we just have to have the fortitude to actually do something about it.
I agree with you. So this would bring it down to 36%. And would that be in keeping with our regional states? Is that what they have?
Well, certainly I think some of them have less than that. But yes, but I think the folks coming after us will certainly have more of those numbers.
They're going to have the
well.
facts?
Yes.
Okay. Well, thank you very much for introducing this.
Thank
Something
you.
that needs to happen.
Well, that 36% surely ain't easy for me to swallow. But if the federal government says 36% based on veterans coming back, is Uncle Sam kidding me? Maybe he didn't talk to the rest of us. But we'll deal with the 36% better than that 280.
Whole lot better, yes.
Any other questions from the committee members? No. Thank you, Representative Barrows. Thank you, Representative Almeida. Now we'll go to the sign-up sheet for Representative Barrows and also Representative Almeida's bill on small loan lenders. Many people signed up for both bills, so if your testimony would include both, we'd appreciate that. Carol Stewart, Leo Sullivan, Jerry McAvey. Carol, would you like to go first?
I would. Thank you, Madam
you.
Vice Chair. I appreciate that. My name is Carol Stewart. I am Senior Vice President for Government Affairs with Advance America. We're a national cash advance company, finance company. We do a number of financial products in 29 states. We are headquartered in Spartanburg, South Carolina. So I wanted to tell you how much I appreciate the opportunity to come today and talk a little bit about our industry and answer some of the concerns that we've heard here today. Before I do that, I'd like to recognize a number of of your local constituents who are proud employees of Advance America. They're here today with the yellow stickers on. They appreciate the opportunity also to be here. And I can tell you from being in a number of their stores, they would welcome you coming in and talking to them, talking to customers, and finding out what really goes on in those stores and how valuable and appreciated this product is by a vast number of our consumers in your state. I want to start just briefly with talking about how this product works, what it does, how it's used, and what the alternatives are for this product. A payday loan is a short-term loan, typically between paydays, up to 30 days. It is, Rhode Island limits it to a $500 loan amount with a 10% fee. The 260% you hear is a little bit of we do report an annualized percentage rate, but because these are 2-week loans, your consumers will tell you that they never pay more than $10 per 100 borrowed. They don't pay $260 on a $100 loan. They pay 10%. They come in and need 3 things to get a loan from us. They bring their pay stub. They have to have steady income. They bring in their bank statement. They have to be banked customers. And they bring in their government ID so we know they are who they say they are. And they will write a check that we will defer depositing. until they tell us that they're going to be paid next time up to 30 days, up to $500. So, for instance, if you want to borrow $100, you would write a check for $110, and we would agree to defer depositing that personal check until your next payday. Out of the checks that we take, about 90% of our customers will come in on or before their payday and pay us back in full. And walk out the door. I know there was a question about the bad debt, the rolling overs, the cycle of debt kind of questions. Our customers typically pay us back. Rhode Island law allows for one rollover, and then that loan has to be paid in full. Customers are making educated decisions based on the other options that they have. And what they tell us in a number of surveys that we've done, and what they've told us anecdotally, is their options are paying late fees on their credit cards. Most of them have credit cards. Paying reconnect fees on their utility payments, or paying a bounce check charge on a check that they've written that's not good. And they do the math, and they see that paying $10 for a $100 expense is a whole lot less than paying $28 to $35 for a bounce check charge. And in a lot of cases, not only would they have one bounce check charge, but between paydays, they may have several expenses that they have to come up with. So they look at those options, those real options that they have out there, and determine that we're the best solution for them. 35 states today regulate payday lending. That doesn't mean that the states surrounding you don't have payday lending. It doesn't mean that if these particular bills pass, which right now do repeal the statutes, both of them do, that you would not continue to have payday lending in your states. You would continue. What you wouldn't have is a regulated product that can be audited, that can be fined by your regulators, and that you can see the transparency with how it's operating. I invite all of you to basically look online and Google Massachusetts, Connecticut, Vermont, Rhode Island, or New Hampshire, any of your surrounding states, and Google payday loans, and you will see literally thousands of illegal offshore websites that will offer payday loans for much, much more than Rhode Island allows to be loaned and to be charged for those loans here. So the unintended consequence is that the need does not go away. The thousands of customers that use the product and depend on the product from time to time won't go away, but what does go away is a regulated 10% fee and a restriction on rolling over the loan, because customers will be able to continue rolling those over. The economic impact, I wanted to talk a little bit about that before I take questions. The industry has 74 employees and adds $5 million to the gross state product, pays about $1.4 million annually in taxes. So we do contribute to the economy. I will tell you as well that we look forward to answering your questions, to having you in our stores, and we invite any of you to come in and talk to customers and talk to our employees. Thank you, Madam Chair.
Thank you. We'll go to Leo Sullivan, and when the panel finishes their presentation, we'll take questions.
Thank you.
Thank you, ladies and gentlemen. I'm Leo Sullivan. I'm Leo Sullivan from Warren. I want to offer some thoughts based on my experience exploring the idea that choices have consequences that are not always clear when the choices are made. In 1994, I was elected to the Bristol-Warren Regional School Committee, immediately became chair. That was very soon after Bristol and Warren regionalized their school system. The system suffered from a very poor image. Test scores were not very good. Taxpayers were annoyed that they were supporting schools from another system. That we had a high dropout rate. Things were not going very well. But I learned there were students who made choices to vigorously challenge the system that was in place. They wanted to strive for personal excellence. After graduating from our high school, some of these students went on to graduate from Ivy League colleges. Some were appointed to U.S. military academies. Some went to other challenging academic settings. Those students chose to ignore the negative image then prevalent in the community and excel within the framework of what was offered to them. At the school committee level, we learned that the framework for excellence existed, so our efforts went into other areas for improvement. Some students chose the challenge and met with greater success than the community expected. More recently, I worked at a branch of a large bank. We often sold customers on the utility of debit cards, talking about their convenience and the ease of use for everyday purchases. As a caution, we always told customers to carefully track every penny that they spent. We gave illustrations of how the ATM balance, when they checked it, may not be accurate, and how they could block the card from overdrawing their checking account. Our efforts were not always successful. Some customers demanded to know how the bank calculated first-day overdraft fees, subsequent per-item overdraft fees, and sustained overdraft fees. While it was in the fine print of the disclosures, customers wanted a clear explanation of the fees, too often after the fact that they had paid the fees. This led some consumers to choose other ways to manage their hard-earned cash. Working for Advance America, customers often relate that our service is preferred to support their banking relationship. Our fee of $10 per 100 borrowed is less than bank overdraft fees. Some customers go right to the bank with our cash to deposit into their checking account. Some like the beauty and simplicity of paying cash. Cash is never on hold, it never bounces, and there's no confusion between PIN and swipe purchase, and when your wallet is empty, your cash is gone. There are no ugly surprises, and nobody can steal your identity when you use cash. And in conclusion, if you choose to limit consumers' ability to use our service, there may be consequences for those consumers beyond what is readily apparent. Thank you for the opportunity to share my views.
Thank you. Jerry?
Thank you, Madam Chairman. I'm here representing the AARP. My name is Jerry McAvoy. I am a resident of East Providence, Rhode Island, which has a very high number of elderly people and retired people in its constituency. And I just want to say that despite all of the good things you've heard about payday loans, they are debt traps by design. According to the U.S. Department of Defense report, the debt trap is the rule, not the exception. In the words of the CEO of Cash America, one of the nation's largest payday lenders, the theory in the business is that you've got to get that customer in, work to turn him as a repetitive customer, because that's really where the profitability is. They want the repetition. It may not go to 260% every time, but they want the repetition. They want those people back. These people get on a treadmill, and they can't be let off easily. I practiced law for 30 years in the bankruptcy courts of Rhode Island and Massachusetts, as well as other courts. You should see the number of elderly people in those courts victimized by things like this. The numbers are outstanding. The business model depends on keeping borrowers stuck in a long-term, high-cost debt. More than 60% of the payday loan revenue is generated by borrowers with 12 or more loans a year. Now, granted, we have restrictions on that already. Putting in 36% is not going to cost 74 people their jobs, nor is it going to ruin the payday lending. This bill is really important as far as that's concerned. Older Americans are often on fixed incomes. I am myself. Carry disproportionately higher levels of debt, which thank God I don't do. They're more vulnerable to the debt trap of payday lending. Nearly 1 in 4 payday borrowers reported some form of public assistance or other benefits, or retirement funds, income sources like Social Security. The harm caused to older people by these lenders are profound. Increasingly, people are nearing their retirement years with high and even unaffordable levels of debt. The consequences of unaffordable levels of debt can be devastating. you end up in bankruptcy court. You end up in receiverships. So, especially at a time when one's life, when income typically decreases, medical expenses increase, and remaining working years are limited. There are now 22 states that restrict or control or bar payday loans. And by passing this bill, you will not be barring it, you'll be limiting the rollovers and the percentage to 36%, which is in line with the federal government, and which is what they recommend and mandate for their returning veterans. And you had a long presentation about how we're helping veterans with the Veterans Court. This will help our veterans as well. That's why I'm urging you to support these bills, payday lending reform, and vote favorably on House Bill 5553 and 5793. Thank you for your attention, and I'll take any questions.
Thank you. Representative Giarrusso.
Thank you, Madam Chair. I just have a question for, the ones represented with the businesses. What is the pay period? When do they have to pay these things back? Like, is it 7 days? Is it a month? What?
It's flexible. It's based on when they are paid again. So up to 30 days. I'm sorry.
No, just
up to 30 days. So typically, if people are paid every other week, it typically is a 14-day loan during that period of time. And I wanted to be clear about the 36% because we've talked about 36%, and some people have included APR on that, and some people have talked about 36% or 36% interest. 36% interest would be over 3 times what we charge today. That's much different than 36% annualized percentage rate. And when you annualize a 2-week loan and take just 1/26 of that, you're talking about on a $100 loan, $1.38 that would be the fee for a 14-day term, which is about 10 cents a day, which, anybody that says we could stay in business with a 10-cent fee that we charge, we couldn't even pay our light bills, much less our employees for that.
So on an advance of a $500 check, you're getting $50 in fees.
If somebody borrows that total amount, our average loan amount is $370.
Okay, so
we only loan up to what they qualify for, what they ask for.
So that's so hypothetically on a $500 loan, it's $50, and that's for 2 weeks.
That's until their next pay period, depending on whether they're monthly or biweekly.
So does it change?
But it could be up to 2 weeks.
So do your fees change if it's 2 weeks or 4 weeks?
No, and there are no late fees. There's no additional fees. So that's why the APR is a little hard to just it's identified as 260% because the annualized percentage rate changes based on the term of the loan. So if the loan's a 30-day loan, the annual percentage rate is going to be 130%. If it's a 2-week loan, it's going to be 260% annualized percentage rate.
Right,
but it still is $10 per 100, which our consumers will tell you, and I think that's what this gentleman alluded to, is that they appreciate the fact that they understand exactly what they're going to pay. And we have big posters in our store that says if you borrow $100, you'll pay $110. If you borrow $2, you'll pay $220. And then actually also list the annualized percentage rate next to it.
Well, because to speak the same language, everybody, when you're assessing any kind of a loan or a mortgage or whatever, it's always in the language of APR. So when we're looking at $50 on $500, that's not really 10%. So I think that's where there's a language barrier in the terminology of the numbers.
That's correct. And a mortgage is over years, and so an APR on a mortgage is a little bit, you actually actualize that because you're paying over years. On a 2-week product, to annualize that, you're not paying it when that loan's paid off in 2 weeks. You're not paying $260 on that $100 loan. You're paying $10 to borrow that money.
Thank you.
Thank you.
Thank you, Madam Chair.
Representative Malik.
Thank you, Madam Chair. Question for the lady from Spartanburg, South Carolina. That's your corporate office in Spartanburg? That
is our corporate office, yes, sir.
What does South Carolina charge their customers?
We charge $15 on the face amount of the check, which is actually a little over $17 per 100 in South Carolina. Rhode Island has the lowest fees that we charge and still stay in business here. There's no other state that has a fee as low as $10 per 100.
So you're saying you charge more in South Carolina than you do in Rhode Island?
We charge more in every state we operate in, other than Rhode Island. Yes, including South Carolina.
Okay, 'cause I was just surprised, like South Carolina, you know, that's big military down there, and to see them, is it capped?
We supported the federal the Military Reauthorization Act and the Talon Amendment that capped that rate at 36% because we looked at where our stores are located, we looked at who our customer base were, and less than a tenth of 1% of our customer base was military at the time. And so we said if there are companies that are not acting in good faith and treating their customers with respect, we support not being able to loan to those customers. The payday loan industry is not a monolithic industry. You know, there are good actors and there are bad actors in every industry, including this one. And the truth be told, a lot of the facilities that you would find right outside of military bases were actually loaning on what the members of the military owned, which is their cars. So they were car title loans and that kind of thing that also did payday lending as well. So we said if this is causing a safety and security issue, we are going to wholeheartedly support that. We do not believe that the rest of our customer base, in terms of the way our company operates and the other companies under Rhode Island law, are being treated in any kind of fashion which could be portrayed as predatory.
Thank you, Madam Chairman.
Thank you.
Thank you. Representative Morgan?
What is it capped at in South Carolina? I understood it was capped at 26%. It used to be 270%. I mean, I actually looked on the internet, so maybe it was wrong, but...
Are you talking about an annualized percentage rate or an
APR.
interest rate?
Yeah.
The APR in South Carolina on $15 is 391% on a $15 per 100 fee.
But you cap
for
it
2
so
weeks.
that nobody can pay that much. Is that right? I mean, I
Well,
just
the
trying
law's
to understand.
similar in that
Nobody's
they don't
paying.
allow rollovers, just like you don't allow but one rollover. South Carolina doesn't allow any rollovers.
So they can only do it one time.
They can do it one time and they have to pay it off in full.
Okay. When somebody gets in trouble, do you work out a payment
Thank you for
schedule
asking that.
for them?
We certainly do. That's one of our industry best practices, and it actually is a part of what a number of states require, which is what we call an exit ramp, which means if somebody says to us, I can't pay you back this loan, I don't want to roll it over, I don't want to continue borrowing, we are obligated by law to provide them with an extended payment plan at no additional charge, and you will not find any other financial institution that's willing to keep their money out on the street for literally months at a time at no additional charge and allow somebody to work their way out of it. So our best practice is 4 equal installments that they would pay us back at no additional charge. So for a monthly customer, they would have 4 months to pay us back 25% of that each time.
So do they request that, or do you at some point say you've rolled it over now 3 or 4 times?
You know, our
and so we're
employees
gonna
will tell
cut
you, and that's
off.
why I've invited you to come into our stores and talk to our employees and our customers. Our employees work with our customers. I mean, we're in the business of being paid back. We don't want to loan money to somebody that can't pay us back because we don't report them to credit bureaus. There are no late fees. We don't take them to court. It's more expensive to hire attorneys and sue somebody over a $10 fee than it is to eat that. So the worst thing that happens to a consumer is they can't get another loan from us if they owe us money.
So at what point, I mean, that's kind of capping them, right? So at what point do you say no more, you have to?
It depends on
pause.
each situation, but, you know, we get to know our customers. We build relationships with them. We know their financial circumstances. If they're struggling with paying us back, if they tell us we can't pay you back and I can't pay you back, we're going to give them that extended payment plan.
So have you codified that in other states where?
We certainly have.
And what's the general codification of they can roll it over so many times and then?
The general codification is even after the first loan, at the first loan, if a customer comes in on or before that loan is due, the day it's due, they can come in and go, I can't pay you back. I'd like the extended payment plan. And we let them know when they take out the loan, if you can't pay us back, this option is available. by law in a number of states, and we have supported that as a best practice. It gives them the opportunity to pay us back.
So at any time that they come in and say, I'm struggling and I can't pay the entire...
That's correct.
Okay, and at that point, that actually limits the APR that they would be paying, correct? Because
Well, certainly
they
it
can't roll
extends
it
the
over every
loan.
2 weeks.
It extends the loan out for a 2-week. A person that's paid every other week, every 2 weeks, it would give them 2 months. It give them 4 pay periods. A person that's paid monthly, it gives them 4 months to pay us back.
Okay. All right. So are there other best practices that have been codified in other states that we don't have here in Rhode Island that help the consumer?
You have a pretty restrictive law. I mean, I think you have no threat of criminal prosecution. You have full disclosures. You know, what states usually look at are several things. They look at limiting how much we can loan, how much we can charge, how a customer uses it in terms of how they get out of the product if they need to, how we disclose, and how we collect on that loan. So those are sort of the 5 policy areas that states look at. And Rhode Island has covered almost all of those.
Okay. Well, thank you very much.
Thank you.
Thank you. Representative Tobin.
Thank you, Madam Chair. Ma'am, so thank you for coming here personally. In regards to your borrowers, okay, and this is going to be a tough question maybe. What's the ratio where you guys pretty much to stay in business need a dependency of individuals, okay, sort of what the gentleman alluded to. And how much money do you guys need on the street in Rhode Island in order to function and have a viable business? So do you need, $1 million on the street a week, and they're getting paid biweekly or whatever it is? So those are my 2 questions. But the most important one is the first one, where people may have a problem, may need quick money to take care of things for the different reasons that you expressed earlier. But at what point does it become an addiction? At what point do people start, putting their check, selling their check before? And then start making plans based on that. Can you give me an answer?
Sure, and I appreciate it. That's a very fair question. That's not a tough question at all. When you look at our company's data, the most of our customers use the product one time, and we never see them. So you have the vast majority of them that come in one time. You have customers, and it's sort of, you think of things as a bell curve. I'm a teacher, so forgive me, but you think of things as a bell curve like this. The way that our customer base is like this, and then it evens out. So you've got most of our customers use it one time, and then it gradually decreases, but it has a tail on it at the end. So we have customers that some of them come in when something unexpected comes up. We may see them one time and never see them again. We may see them seasonally. They need to buy Christmas presents for their children, back to school supplies. Something unexpected comes up, and they're, in the winter, their child's sick and they need medication for them. So we see them periodically because they appreciate the service that we offer. We also have a small number, a minority of our customers that use it to smooth their income. In other words, they have got more bills than they have paycheck. They have cell phone bills, they have cable bills, they may be buying their first house, they may be paying off student loans, and they just aren't quite making enough to make ends meet. Or they don't get paid when those bills are due. So we have some customers that use us monthly or every other month to sort of smooth their way so they're now not bouncing checks until that money comes in. We also have customers that are paid seasonally, paint contractors, painters, people that are paid on commission, and those checks may come in, in the summer they may make a lot, in the winter they don't make quite as much. So we may see people use it episodically where they use it 2 or 3, 4 pay periods at a time, and then we don't see them for 6 or 8 months. So there's not one answer in terms of how people use it, which is why it's really hard to set arbitrary governmental limits on consumer use, because there's not one model that fits. What you will hear from a number of the consumer activists that will be talking after this is they'll try to portray customers that have used it to smooth their income regularly and have gotten into trouble because they've taken 3 or 4 of these out at a time, and they will try to portray that as our business model. If that was our business model, number one, we wouldn't stay in business for long because people couldn't pay us back. And number two, there would be a ton of complaints in the state. And I think the latest complaint data I've seen from our regulator here is there have been 2 complaints about regulated payday lenders over the last 3 or 4 or 5 years. We can get you that exact number, but consumers appreciate it. The people that are actually using the product aren't complaining about it. And if they thought they were being taken advantage of, if they thought that they were victims, they would be screaming to everybody they could, that, including the state and the regulators, that this is a product that doesn't work for them, or they're being treated unfairly.
What makes you different from the ones that we may see on TV with certain personalities, Hollywood or talk show hosts? What makes you guys different? Because those, again, I've seen and read about things that are practically criminal.
And those are the online lenders that are because they're on TV in this area. They're marketing not only to Rhode Island, they're marketing to the states that don't have a regulated storefront product. So, that's not us. We're the storefronts that are regulated and are charging no more than $10 per 100 and limiting people to 1 rollover.
Representative Tansey.
Thank you, Madam Chair. So I just want to start by saying internet loans are illegal. So I heard them referenced in your testimony and referenced again in response to Representative Tabone's question, but it is an illegal product. So it's as illegal as loan sharking is. So I just want to make sure that people understand that. And I have a few questions for you. You had mentioned it requires 3 things in order to access your loans: a paycheck, a bank account, an ID. So do you also accept Social Security?
As any steady source of income, we do accept.
So disability insurance, all of those are considered paychecks?
Correct.
And what kind of underwriting do you do to make sure someone can afford the loan?
We have a very complicated proprietary underwriting process that looks at how much somebody takes in, that looks at their bank statement and how much they're expensing out of their bank statement, their checking account each month, and apply a % of income test to those customers.
So you do that on the spot?
Well, it's all done by computer. It's all entered into a computer, and the computer, the analytics on the computer does the algorithm to determine how much we can loan somebody.
So their entire bank statement is used. It's not just that they have a bank account.
We look at their bank statement as part of our due diligence in determining how much we loan people.
And so you
Yes.
see their rent check, you see what they pay for their credit card, you see what they pay for their cell phone, and you're making an analysis that this is in fact a loan that they can afford.
And we also look at what NSF charges they have, and a number of other things. So, we don't want to loan somebody more than they can pay us.
How does that work within a state that has a different rate? How do you verify?
That preempts the state law. So the bottom line is that we don't loan to military at all. We had a few people that have complained about that have come in and didn't realize that they were basically shut out or redlined from getting loans from us. I assume some of them have gone online. Even though a number of those loans are illegal, it's hard to find those internet sites and the source of them and shut them down. And, we've had attorneys general from around the country that will attest to that because they've tried. So, I'm not promoting internet lending or offshore illegal internet lending, but I'm just stating that that's an unintended consequence that our consumers tell us is out there as an option to them.
Okay, so what percentage of loans are turned down? I didn't realize that you did any kind of screening. So what percentage
absolutely.
do you actually turn down?
I can get you that number. I don't have the exact percent for Rhode Island.
In general, I'll take a national.
I don't know. I can find out.
Okay, and sir, I didn't catch your name. You were in the banking industry. I'm sorry, what was your name?
Leo Sullivan.
Okay, Mr. Sullivan. Do you know what was your experience in banking? You worked,
I worked at a branch for 5 years.
and were you involved in loans at that time?
Some, we would do home equity lines of credit. We would refer mortgages to a mortgage person, but mostly was, focusing with people on the line, advising them, trying to sell debit cards, explaining how they were used.
Okay, so you weren't a loan officer per se. You were more of so you didn't have the experience with approving folks who analyzing their credit.
No, I did not.
Okay, and what's your capacity now? You work at Advance America, was it?
I'm an assistant manager with Advanced America, yes.
And you currently are involved in the screening of your clients and analyzing whether or not their debt-to-loan ratio is a sustainable one. And
in some ways, I mean, we as she mentioned, we look at different things, and the computer does a lot of it, but there is some human interaction that has to be done with bank statements and other qualifying things, and it's limited to that.
And what percentage of folks would you say are turned down who come in?
I can only speak for the experience that I have, and it's not representative, so I'd rather not give you any information.
Well, I think you're here to testify to your experience, are you not?
We can get that information to you. I'm one of 3 people who work in that center, and I can just tell you what I do.
Have you ever had one turned down?
Yes.
Daily? Do you have at least one a day? Do you
No.
have?
No.
Thank you. I appreciate that. I think it's important, the people even on this committee, you keep saying it's $10 on every $100 loan, and yet our brains, and we are the finance committee, we understand things in terms of an APR. And I even heard at one point you, Ms. Stewart, say 36%, and after chiding us for not using APR. So I think it's very easy for most people. I think it's an unusual person who, when they're talking about a percentage rate for a loan, that doesn't think of it in terms of annualized percentage rate. So, I think that it's easy for you to say it's only $10 per 100. But for consumers to really get at the bottom line, I think it's important to have it expressed in the APR. And I'm just going back to the experience, sir. When they pay, they come in. It's been 2 weeks or 30 days. What is the experience of rolling something over? The law says that we're allowed to have one loan rolled over. So they have the check for $110 that they've left with you when they signed their contract. Tell me how that experience goes when someone walks into your store and what the rollover experience is like.
Well, for the most part, people who walk in will, if we know them, say, hi, how you doing? If not, we'll ask them for their phone number, and once we know their name, say, hi, Teresa, how are you today? Your loan today is $110, whatever the value is. We get their file, they give us their cash, we confirm that it's what it is, give them whatever change, give them their uncashed check back as a receipt, and follow up with, do you need another one today? If not, have a good day, enjoy the sunshine, whatever, a little chit-chat. Next time you need us, we'll be here. If they do need another one, how much do you need? All we need is another check. Please fill out your check, and we'll take care of it from there.
And you get to know your customers, as Ms. Stewart said. It's because people come back frequently.
Not necessarily. We try to, by looking them up by their phone number, it's somewhat anonymous for them. It's also a unique identifier of who they are. But we need to be able to get their file, get their information. We have a picture of their license to make sure that they are who they are claiming to be.
So the check is not cashed. Say they said, you know, we're good, go ahead and cash my check. It's always $110 cash that they would present, and then you would give me my check back. My post-dated check, is that the process then?
It's not a post-dated check. The day you come in, you date the check for that
day?
Correct.
Okay. Say I didn't have the $110 that day.
If you're there on or before your due date and you come up and say, look, I can't pay today, I'll say, well, can you make a down payment today? Do you have anything you can put down? We do have an extended payment program that you can enter into. And then give them the details of that. If they do have a down payment, that goes against the balance of what they would pay over 4 equal installments.
But just the regular, the quote-unquote rollover that you referenced, how does that process work? Do they pay you $10 that day?
We don't do rollovers in Rhode Island. It's a term that we don't use. Our corporate does.
But law allows it.
Law allows it. We, if they have $10 to put down, we accept that as a partial payment and then divide the balance into the 4 remaining payments. We have them sign an amendment to their contract and give the copy with their schedule of due dates and what is due.
So there is no rollover then? It's just a partial payment, and then it automatically goes into this extended payment plan, the exit ramp?
Well, it's not automatic, and they have to ask to enter it. They are limited to 1 per year. So if they've had one in the last year, they're not eligible for that. But yeah, we explain to them how it works and encourage them to help them pay it back to go into it.
And Ms. Stewart, when it comes to the 36% that the feds implemented, how did that impact Advance America? Were there states that you had to leave because the majority of your clients were military?
No. Less than, I think I said this earlier in my testimony, less than 0.1% of our customer base was military, so we actually supported that because we don't locate our stores outside of military installments, and we weren't lending to military before that went into effect, so it had no effect on us.
And I guess that's all.
Thank you. Representative Tobal.
Thank you, Mr. Chairman. Okay, so now, what happens if they exhaust that one courtesy? Where do you take it from there?
Well, once they paid that back, we ask them to be sure that if they need another loan, that they can afford to pay it back. This process of working with customers, we always review the value that they're paying back, the value that they're being lent, the percentage rate, the finance charge, and when it's due.
I understand that. That's very clear. I'm just saying I borrow today, I pay. I borrow tomorrow, I pay. I borrow the next time, I go in default, we do a plan. I pay back. That was my one-time courtesy for the year, according to what you said earlier. I borrow next time, and then I fall in default. What happens then?
You can't get another loan.
I understand, but after I pay you back, if I went into default and I did a payment plan with you,
Okay.
I pay you back, will you give me another loan?
If you pay back in full, yes.
Okay.
If you say you need it, we will do that.
You said there's a one-time courtesy of a payment plan, right, per year?
Yes.
Okay, so I do some loans, and then within that year I fall in default again. What happens then?
We will attempt to deposit your check and contact you on a daily basis saying, please come in and make good on your check.
Okay, all right. So then the other thing is that my understanding, there are two major entities in Rhode Island, yourselves and others. So you guys are Advance?
Advance America.
Advance, and then I think there's like a Cash one, right? Cash America or something like that? Well, you may know. I mean, you're local. That's your competitor.
The other national company is Check Into Cash, but there are a number of local lenders as well.
You know, you guys are coming
are
off,
here.
and I say this respectfully, you guys are coming off as, you know, really nice people and really nice company. And the thing is that, do you think that the other companies and their business practices are like yours, or do you think they may hurt your image?
I think they follow the law, or they would be under a cease and desist order by your regulator, because you do have a strongly regulated industry in this state.
Okay. Rhode Island tends to be very special. So. Okay, and here's another thing. Do you guys, and when you have the conversations with your clients, whether they're your customers, whether they're repeat or not, do you educate them and try to put them on, you know, teach them how they may not fall into this habit or I call it an addiction of just having money ahead of time and sort of you know, compromising their check, you know, in advance. So because we can agree that people sort of could fall into that, right? You'd say no?
They could.
Okay. So I was just curious, do you know, would you say, and I don't think you need to get personal, but if you say, hey, you know, I've seen you here a few times, or have you checked your finances? I work in insurance and I work in financial things, and I know that if someone needs to put some money away and they pay for the cable, but they don't watch TV, I say, well, maybe that's something we may want to look into, and, you know, so you could have some money put away to address other things that may be more important. Do you guys do that in any way? Do you guys have any signs anywhere inside? I know you're in the business of selling money. That's cool. I mean, this country allows it. The state allows it. You guys are contributing to the economy. But we also want to make sure that we're taking care of the people. And so I was just curious if you guys have anything says if you feel you're falling into debt, call this hotline or anything inside.
Every time we start with a new customer, we give them what we call our CFSA brochure. CFSA is the legal framework under which we operate, and it explains to them the extended payment program, their use of credit options, and about every fifth time we're prompted to supply that information once again. So that's on a formal basis. Mostly it's just, you know, here's some information we'd like you to have. Informally, if somebody comes and makes a comment about their situation, we can work with them. But as far as we're concerned, you're here for your private business. We're here for a service to help you. You can use that service to however helps you, and we'll try to help take care of you. We don't get into the specifics of their situation.
Okay. Thank you very much. Thank you, Madam Chair.
Representative Barros.
Mr. Sullivan, I don't mean to be disrespectful, but if I heard what you said earlier, and you said you were going through this analogy, you were basically, if I understood you correctly, you were blaming the borrower for the problem. When you were alluding to, you know, that people take responsibility, and this, I don't know whether you were reading from a prepared statement or not, but you were basically saying that people take responsibility, and that's what your initial statement. So, are you saying that it's the borrower's fault that they fall into the addictiveness of the process or the practices that you guys provide?
I was not saying that. What I was saying is that it's important when you're considering these bills to realize that there are a lot of our customers who find a value in our service. And if you change it, if we're not here to provide a regulated service, they will fill a need some other way.
Mrs. Stewart, now you said that if you were not here, that I guess what is was if the need would not go away. That was your comment, was not
That's
it?
absolutely correct. And that's what our consumers tell us. I'm not making that up.
No, I'm not doubting that. All I'm just saying is that here in Rhode Island, obviously, many of the nonprofit organizations have realized that this is an issue, and so they've partnered up with some of the banks, and we do have other alternatives at this point. We have Navigant Bank willing to make those short-term loans. We have other entities willing to do that. So, I mean, we're a small enough state that we're hoping that by, one bank taking the initiative to do this, that we will see more banks take over some of the services that you guys are currently offering, and then when offering it at a very high rate annually.
And we welcome that competition. I mean, what we have seen from the data from Navigant and other of the nonprofits is that the size of the industry that they're capable of handling at this point would not make a dent in the need that's out there with the millions of dollars that are loaned by the regulated storefront lenders in this day and age.
That leads me to a segue to my next question. So you said that I'll rephrase the question. How much money did Advance America make last year? In Rhode Island, that is.
I don't have that figure. I can get it for you.
How about the average income of the individual coming into the store to borrow money?
I do have that information for you. I have our customer demographic information. Hold on just a minute. Let me turn to it. So I give you the exact right numbers. Here we go. Our customer's average age is 43 years old. It's typically between 25 and about 45 years old, but the average age, most of our customers are in their early 40s. The median household income is $56,228 a year. So when you look at that, you see that a number of our customers are school teachers, hospital workers, civil service workers, retail workers, government workers. So they're people that about over half of them, about 56%, own their own homes, and 95% of them have high school or some level of college degree.
Thank you.
You're welcome.
Thank you, Madam Chairman.
Thank you. Representative Morgan, a brief question?
Thank you. I know this is getting long. The folks that get into trouble are those that roll it over and roll it over and roll it over until it consumes a large percentage of their paychecks, right? They're just not making $56,000 a year or whatever you said. So I wanted to talk to you just a little bit more about the best practices that you support. You said they have to self-identify that they're having problems. Is there any point at which you say we could codify that after 4 rollovers or 5 rollovers, they have to take a pause and work off the debt before they can come back in and do it again? Because that's when they get into trouble, when they're multiple times every 2 weeks paying $50 and cutting into their next paycheck.
You know, I think the problem with setting an arbitrary government limit is that not all customers use the product the same way. So the problem with that is if you cut somebody off after 4 loans or 3 loans or, whatever that number is, and the need's still there, they're going to go to a more expensive option to meet that need. And so, while we try to work with our customers to ensure that they can pay us back, we offer them the extended payment plan. We won't loan to them if they can't pay us back, so they can't keep getting into that trouble.
But you're saying they have to self-identify at that point, and some of them are, obviously, they wouldn't be coming to you if they didn't have a desperate need. So is it a percentage of their paychecks, or if they're borrowing more than 20% of their next paycheck or 30% of their next paycheck? Do you stop them there? I mean, at some point, you want your money back.
Sure.
So if they're if
Well,
the
and we won't
fee
lend to 'em to
is
begin with if
consuming
it's-
80% of their next paycheck, you certainly.
we wouldn't lend somebody 80% of their paycheck.
So when do you normally just shut them down?
Well, it's not that we shut them down. We wouldn't ever lend them that amount to begin with. I mean, we wouldn't let them have 80% of their paycheck out as a 2-week loan. I mean, as I say, the average is $370 that we'll loan somebody. We don't, if you walk in, we're not automatically going to give you a $500 loan if you don't qualify or need that $500.
But you get what
so
I'm
we do
saying.
it up front. Up front, we will make sure that they're not loaned more than our due diligence says that they'll through our computer
So if they
system
borrow
and our algorithms
$300
say
and
they
the
can pay
next
it.
time they come in they have to pay $330, but they roll that over and now it becomes $360 and then $390 and then.
And Mr. Sullivan corrected me that we don't do those rollovers, even though you allow them in your state. We make them pay us back in full, and then they have the option, just like when I use my credit card to pump gas and pay my credit card on time, I have the option of using my credit card at the grocery store the next day. So they still have that option of coming back in and getting another loan when they need it. And if they need it right away, then they have that option as well if they've paid us back. If they haven't, they don't have that option.
Okay, thank you very
Thank
much.
Representative Tansey, is it a brief question?
It is. Are there any other industry representatives here, or are Mr. Sullivan and
Well,
Ms.
we do
Stewart?
have a sign-in list.
Are there? Are you aware of any others?
They
Okay.
do not have.
Oh, okay, the affiliation or anything.
affiliation.
I will make it quick. You have multiple locations throughout the state. Advance America. How many locations do you have?
I think we have 19 locations here.
So I could walk into your locations, Mr. Sullivan, take out a loan, and 13 days later, walk into one in Westerly, take out another loan.
With us? No.
Not without paying the original loan back. Our centers, our company has a database where all customers are recognized. So if you come in and have a loan outstanding, I put your information in. I say, oh, you've got a loan outstanding elsewhere, you have to pay it off. You can pay it off at my center. But you could not have more than one loan outstanding with our company at one time.
So you have a company-wide database that their name would appear.
Correct.
All right, that's contrary to other things that I've heard, but I guess, you say you don't do rollovers, and just like the 10% versus the APR distinction, precision of language is very important. And when I asked you to describe what happens when someone comes in to pay off their debt, you stated without skipping a beat, they pay us the $110, and I say, would you like to take out another loan? So that, to me, is your business model. That's how we get to a APR rate that we all understand, and that I think the advocates who are out here are talking about, because my guess is you get to know those customers so well because the answer to that is more frequently, yes, I would like another loan, than it is now. And from other things that I've heard at other hearings and other testimony that other people have given is that it's not only the mom, it's then the mom and the dad, and then maybe even the son. And so it's an entire family that is swimming in debt together. So I very clearly understand your business model, and I thank you for the ability to ask that final question, Madam Chair.
Thank you for your testimony. I'd like to ask Libby Kimsey, Margot Morriso, and Reverend Don Anderson. Welcome to House Finance. And if you wish to only comment on one bill, please identify that bill. Otherwise, we'll assume you're talking about both bills. Thank you. Reverend, would you like to go first?
Yeah, I'd like to let the ladies go first.
All right. That's very gracious of you. Thank you.
Well, they're smarter than I am.
All right. So we're going to have Libby first?
Sure.
Okay.
Thank you for the operating
Thank you. Libby Kimsey, thank you for the opportunity to speak, Chief Operating Officer at Capital Good Fund. We are a nonprofit community development financial institution here in Providence, Rhode Island, and I'm here today to support the House Bills 5553 as well as 5793. Capital Good Fund, we do small loans. We also do one-on-one financial and health coaching, topics around budget, savings, credit, and debt. One of our most popular loan products is designed as an equitable alternative to these payday loans that we've been hearing about tonight. Instead of charging 261% APR, we charge 30% APR with a 4% closing fee. This results in an average savings of about $400 to the individual. So we calculate that figure because data shows that the average person is rolling over 8 times, whether it's the formal rollover or that more casual rollover, and that's how we have determined that we offer an average savings of $400 in the life of the loan. What's more, we report payments to the credit bureaus, and in our client base, we've seen an average improvement in credit score by 65 points of our borrowers. We were able to launch this loan product at the end of 2013 with support from the United Way of Rhode Island and others. And since then, we have dispersed 200 loans. Our 200th loan went out earlier this week, and that totals $90,000 with a 90% repayment rate. Like the payday loan purposes you've been hearing about, our mix is very similar. It's catching up on rent or utilities, it's repairs to vehicles, it's those short-term needs that can get people to next month. What's different about our product is that we're not expecting someone to magically have that money that they didn't have 2 weeks ago and have it 2 weeks from now. We're saying pay us back over the year because we don't want the trouble you experience today we don't expect things to turn around magically. The success of our emergency loan does demonstrate that there are ways for families to meet these short-term cash flow needs aside from payday loans. We have seen sources that for payday lenders such as Advance America, the customer acquisition cost, or basically the cost of their marketing and their sales operations, means that they need to make at least $100 in profit from that customer in order to break even. And so that means that they have an interest in, as Representative Tansey pointed out, in bringing that customer back, in having getting to know them very well. What's different about us? We conduct sound underwriting. We look at ability to pay. We firmly believe that capping the interest rate and closing this loophole in the law to force all lenders to charge an equitable 36% interest will force agents such as Advance America to change their business model or close up shop. And either way, we are ready to step up demand and help consumers in Rhode Island meet these short-term needs. Payday lending isn't just a moral issue, it's also an economic development one. Every dollar a borrower spends on interest going to the corporate headquarters in South Carolina is a dollar not spent in the local economy. Financial instability affects productivity at work, affects the lives of children. Good news is that we know how to address the issue. 36% APR is a fair interest rate, and it's one at which lenders who are responsible with innovative business models can soundly underwrite the applicants they meet and meet the financial needs of Rhode Islanders. So thank you for the opportunity to present, and I welcome any questions.
Thank you, Libby. Margot?
Thank you for this opportunity. My name is Margo Morriso. I am the co-chair of the Rhode Island Coalition for Payday Lending Reform, but I'm also the director of community engagement at a community development corporation that serves Northern Rhode Island. We have about 350 rental units across Northern Rhode Island and serve low-income working families who are really trying hard to move up the economic ladder. One of the things that I've seen time and time again are people who are getting their legs knocked out from underneath them by a payday loan. Payday loans become a burden to the family, and they take needed money away from the family that could be used on things like food and medicine and rent. And I've seen people lose their homes because they're caught in the debt trap of a payday loan. In 2011, after seeing this multiple times with the families that I was working with, we started to address this issue. We have addressed this issue by submitting legislation year after year, by working with partners to create alternative products, which was requested of us from this committee, and then also by working with financial coaches and financial opportunity centers across the state of Rhode Island to make sure that people are educated and know how predatory and harmful payday loans at 260% APR are. Some of the questions that you asked, I'll try and answer. I do not have up-to-date data with DBR. I do not have this year's data with DBR, but I can tell you that over $70 million on payday loans is spent in the state of Rhode Island year after year. If you look at the average loan, which is about $384, that means about 182,000 loans were made in Rhode Island each year, and that number has consistently gone up year after year. We talked a little bit about the unnecessary economic burden on families. I think one of the things that it's good to note is that the information that we're providing to you is from independent research studies. This is not our own industry data. This does not benefit us personally. We are not paid hired lobbyists for an industry. We are looking at independent data that was provided by Pew and Insight, both reputable organizations. So I think one of the things that we've talked about a couple times is about the economic drain on Rhode Island. And it's important to know that we've been trying to fix this in Rhode Island for the past 5 years. And each year the bill is held for further study. But every time that we decide to hold this for further study, we know that millions of dollars are leaving Rhode Island. $1.6 million a year. So if you times that by the 5 years that we've been trying to fix that, it's been a lot of money that's left our state. I want to go over some of the information, I should say, the misinformation that was given by Ms. Stewart. She said that most people use the loans one time. That is incorrect. We know that we have data that says that most loans are rolled over 8 times. If you pay off your loan and 5 minutes later you take out another loan, that is technically a rollover. She said that there weren't a lot of complaints about payday loans in Rhode Island. That's because you cannot file a complaint about a legal product. Unless payday lending is deemed illegal or interest rates are lower, then complaints can be reported. But as it is right now, people cannot complain about this legal product. She also said that most of the loans are made to people who make over $60,000 a year. We know that is completely false. 2/3 of the people who take out payday loans make below $30,000 a year. And 1/3 of the people who take out loans make between $10,000 and $20,000 a year. They talked about how payday loans are cheaper than late fees and reconnect fees from utilities, and how their fees are very affordable. That is really not the case. What I have witnessed time and time again is that when somebody takes out a payday loan and they give you a post-dated check, which is in fact an illegal practice, that check can be deposited up to 3 times a day. And I've seen this on bank accounts where that post-dated check is deposited 3 times a day, so you're getting bounce check fees 3 times a day. That means that most people's bank accounts, when that starts to happen, are closed down. That means that we're taking people who are high at risk financially and making them unbankable. That makes them even more vulnerable. There is also some talk about the surrounding states and how payday loans are actually happening in surrounding states, and that is not the case. In all of the states in the Northeast, the cap is 36% APR would actually be the highest APR cap in the Northeast, and they probably were referring to online internet loans. Those loans are also illegal in all those states. If those loans are taken out legally they do not have to be repaid. So the loan company cannot collect or press charges against the person who has taken out an online loan. I also included a lot of information in your packet. That's why I didn't go through point for point. There's some fact sheets in there, and also a representation of the members of the coalition. The members of the coalition are over 50 people and multiple organizations strong. We represent Rhode Island. We represent our communities that we serve. We do not have a personal interest in this, and we know that most of Rhode Island would love to see this reform passed. So thank you for hearing me tonight, and I'm happy to answer any questions.
Thank you very much. Reverend Anderson.
Thank you, and thank you very much, Madam Chair.
We need to push, yeah, thank you.
Thank you very much. I'm Donnie Anderson, Executive Minister of the Rhode Island State Council of Churches. I'm here also officially representing the Interfaith Coalition to Reduce Poverty, and can speak on behalf of the major religious traditions that have held press conferences in the past to share with you that 260% interest rate is so far beyond usurious that it's really ludicrous to even think about that. For us to make an exemption to our usury laws to say that you can charge 260% for any product is contrary to every religious tradition that I'm aware of. The other way of thinking about these loans is, and I'm more a meat and potatoes kind of guy, right? Think about this for a second, because most of the loans are 2-week loans. That's where most people are paid. You take out a loan. That is a balloon payment loan. In other words, I don't have the money today, but somehow, magically, within 2 weeks, I'm going to be able to make a total balloon payment of paying the principal and a payment on top of that back. Just think about it from common sense. I appreciate Representative Chansey because words get thrown around like, is it technically a rollover? Well, if somebody comes in the next day and takes out a loan, technically that's not a rollover, but for all intents and purposes, common sense would say that's a rollover. And the data that you've been provided has not been created by us. It's been created by objective nonprofit organizations that have studied this issue and looked at this issue. As far as the complaints are concerned, let me just share another aspect of this. I've met with some people who've been victimized by these loans. They are embarrassed. Okay, they feel silly. And the last thing in the world they want to do is come up here and say, I was really dumb. Now, look, that's only human nature, right? So there's a lot of this. What happens is people just try to cover it up, and that's one of the reasons they keep going back and rolling over. The Pew study says this, that 81% of the people who take out payday loans said that if payday loans were not available, they would use some other source to figure out how to get through their problem. And they weren't referring to online loans. They were talking about maybe going to their relatives and asking for it. Look, I remember times in my life where I was a pastor of a real small church at times. I didn't have much money. I had to go a couple times with my hat in my hand and say to my dad, I need some help to get through. And, my family helped me. Had there been a store right down the road that was slick and everything, I might have fallen for that trap. I'm just going to be really honest with you. So 81% of the people said there would be another way to address the problem if the product wasn't there. So the statement that if the product goes away, people are in deep trouble is not true. And let me just answer one other question. Representative, you asked, in my mind, the most important question of the night. And it is clear. And let me share with you the answer. You said, why haven't we done anything about this? The reason we haven't done anything about this is because, for whatever reason, this has not been able to leave the committee. It's not gotten to the floor for a vote. And our request of you tonight, as the Finance Committee of the House of Representatives of the people of the state of Rhode Island, would you please pass this out of committee and let it go to the floor for a debate and for a vote? Thank you.
Thank you. Thank you, Reverend Anderson. Any questions? Representative Barrows.
That's right. Libby, thank you for coming. Mrs. Stewart says that if they were to leave the state, you guys would not certainly have the capacity to handle all of the influx of loans. Would you think that there would be some, collectively amongst all the various groups, that there would be some way that you guys could actually handle some of the those loans?
Thank you for your question. Absolutely. We are not the only institution doing these kinds of loans. Navigant Credit Union has been mentioned before as someone who's risen to the challenge. We have grown a lot with the support of United Way to launch this program and are still in the process of ramping it up, but our numbers are growing each month. We have an online loan portal where applicants can go and complete the application, upload relevant documents from their own home, and then they would just come to our office to sign the contract and pick up their check. So we absolutely have faith that there are ways to meet short-term cash flow needs without the payday lenders here in the state.
And just a follow-up question to that, it says, you guys are making it on 36% and APR, and if you heard what Mrs. Stewart said, that wouldn't even help them pay their light bill, if I'm correct.
We might have a more frugal operation. I haven't seen their profit and loss statement, but we're doing all right.
Good. And I have, Madam Chairman, if I can, I got a question for Margot. I actually two questions. Margot, could you probably just talk a little bit about the federal regulations that are in process or in the works?
Sure. The Consumer Finance Protection Bureau has been having public hearings to come to formulate some kind of response. They recognize that payday lending is a predatory product and that this is a problem around the country. They've been charged by President Obama to come up with a solution. While they're not allowed to address the interest cap, they have floated out some really innovative ways to solve the debt trap. One of the things that has been talked about that is would be very helpful is a cooling off period of 30 days, which means that you could not roll over a loan within the same sitting with a representative. You would have to wait 30 days before you were able to take out another loan. There's also been talk about making sure that people are able to repay the loan. Even though the industry talks about how they look at bank statements, I know cases where that is not true and loans are given out without the knowledge of the ability to repay. So the CFPB ruling would require an ability to repay. So generally, we're in support of the CFPB regulations as they're being proposed right now, but we also would like to make sure that the playing field is even for all lenders in the state of Rhode Island, and the only way to make it even is to take away the special carve-out that the payday lenders were granted.
And the last question, Madam Chairman. Now, if we heard what Mrs. Stewart says, that will sort of debunk that whole thing about the 36% in the neighboring states. She says that that's not actually the case.
That is not the case.
Can you tell me what, specifically what Connecticut, Massachusetts, and some of the other states?
I do not have those numbers from the top of my head, and I usually provide that in the packets. I'm sorry I didn't today. But I want to say Massachusetts is extremely low. I want to say that they're about 18%, but most of the neighboring states are between somewhere in the range of 18 to 36%. I think Connecticut's around 26. So at 36%, we would still be the highest in the Northeast.
Thank you. Thank you, Madam Chairman.
Right. Representative Giarrusso.
Thank you, Madam Chair. First of all, Margot, on behalf of my seatmate and myself, you hit it out of the park. Great job.
Thank you.
But you did answer some questions that were asked, but there was one question I didn't get an answer to, and if you don't have it, if you can get it to me, I would appreciate it, about the number of people that are in bad shape, like that are just crippled and they're paying more in these interest things than they are in their paychecks.
Yeah, we do not collect that data in Rhode Island. So the Department of Business Regulation only collects the loan volume, and and it's by year, and we do not have the current year. I do have anecdotal stories about clients that I've worked with, and I'm sure Libby can tell you many anecdotal stories as well. Unfortunately, just about every person that I've talked to who has taken out a payday loan has ended up in worse shape than where they started.
Thank you. And Libby, I heard about your organization on the radio on my way to work a couple of days ago, and what you're doing is capitalism at its best. If you're offering these products and services at the rates that you are, I think this bill will kind of fix itself, because capitalism, and that's what's going to happen anyway. Just by osmosis, it's going to happen. So I'm glad you're doing that.
I agree to some extent, but I think the Reverend Anderson brings up a fair point as well. These organizations are spending a considerable amount of money to market and sell these products, and they're not always needed. So because we underwrite these loans in a way that the payday lenders don't, we're never going to have the volume that they do. We're reaching a subset. So you can't have just market alternatives. You have to meet that with regulation. And I think closing the loophole is a really meaningful way to do that.
Thank you. And Reverend Anderson, thank you for the kind words. Your flattery will get you everywhere. And
Well, it's the truth.
but the other thing I wanted to point out is we heard a lot of things and a lot of stuff we were wondering, just how accurate it is. But the thing that really blew me away is that they don't do business with veterans. To me, that speaks volumes. Is it because they're mandated to pay a lower fee? That's pretty mind-boggling. Thank you so much. Thank you, Madam Chair.
Thank you. Representative Tansey.
Thank you, Madam Chair. Ms. Kimsey, of your 200 clients, how many have have come to you from payday loans?
That's an excellent question. The 200 number is for our emergency product, which is very similar to the payday loan, up to 500. I don't have the exact number, but it's a quarter to a third have had that there's a payday loan in the mix there. We actually have a different loan product that we call our debt assistance loan, which is up to $2,000. And the reason it's a different product is because typically people come to us, they have one loan from Advance America, they have one from Check and Go, they might have another one that's from the internet, and a 500 loan isn't going to get them out of that problem. And we're committed to, we don't want to add debt in a way that's not constructive. So our debt assistance loan is meaningful when there's a number of payday loans or other very high interest debt, and they are looking to get a clean start.
And you offer counseling in conjunction with that?
Absolutely.
All right. Thank you, Madam Chair.
Representative Tovar.
Thank you, Madam Chair. And I just want to, thanks. I just want to say, I've been to Capital Good Fund, and I was doing a little research, and I went through the process, just trying to figure it out. And they do that. They sit down with you. They ask you, what you need, and then they go a breakdown, and they do the numbers as to how much you make, and to see if you are going to be capable of doing the loan, and then they make recommendations, and they want to put you on a track to get on and get off as soon as possible. So that is comforting to know that you guys are there. You guys can't provide the solution to the whole thing right now because, funding wise, and Representative Tansey took my question of how many actually, how many do you inherit from other payday services, which I can only imagine many. The other thing is how many loans do you guys deny?
Sure. Across all our loans, it's about 50% approval.
That would be it.
So it's a little, our approval is a little bit higher in the emergency loan, 60 and change %.
Okay. Great. Thank you. Thank you, Madam Chair.
Thank you. Thank you very much for your testimony. I appreciate you coming forward. I'd like to ask Leanne Byrne, Jonathan Jacobs, and Randall Rose. Welcome to House Finance.
Thank you, Chairwoman and members of the committee. I know that you've been here for a long time, so I'll be very brief. I'm Leanne Byrne. I'm the Policy Director from the Rhode Island Coalition for the Homeless. I'm here in support of both Representative Barros and Representative Almeida's bills. We believe that these are important pieces of legislation to increase economic security for our constituents who are experiencing homelessness or Rhode Islanders who are at risk of homelessness. In Opening Doors Rhode Island, which is the state strategic plan to prevent and end homelessness, we've identified increasing economic security as a main goal. These loans create a cycle of debt for individuals utilizing the service, and the interest rates on these loans are inherently antithetical to this goal. For our constituents experiencing homelessness, the harsh cycle of payday lending is especially detrimental. Economic security is vital for our constituents to ensure their housing stability. Our national partners at the National Income Housing Coalition have said that renters are 57% more likely to turn to payday loans when their finances get tight. So we support this legislation as a way to prevent homelessness so that the high interest rates of payday loans do not put families at risk of losing their housing because they cannot pay their rent. And again, we're in support of these regulations, which we believe are fair and close an important loophole in Rhode Island law, and I'm happy to take any questions.
Thank you.
Good evening, Madam Chair, members of the committee. Thank you so much for your time and dedication to Rhode Island and to the financial empowerment of its citizens. My name is Jonathan Jacobs. I work in advocacy for a number of organizations that promote and protect working families in Rhode Island. I just have to say that this so far has been a group of individuals that's been the hardest hitting and most in-depth in terms of really getting to the bottom of this issue, and I've testified on this issue this is the third year in a row now, so it's really refreshing to see a group of people that really seems genuinely interested in getting to the heart and soul of what this issue is all about. Here we use the term predatory lending from our perspective because I'm testifying in favor of both of these pieces of legislation. And a predator is a person or entity that exploits those weaker than itself. Here we seem to have an example of a blurred line between exploitation and the free market. And one of the ways that we can clarify is to ask the question, how much does this example of the free market cost those who are least able to afford it? Another germane question is, how much does this particular free market sector cost the state in exported revenue in the form of earnings paid to corporations based in other states? And in the case of Advance America, other countries, because while its American headquarters are located in South Carolina, it's an international company, and its global headquarters are located outside of the country. So we're looking at money that is exported not just out of Rhode Island, but out of the country. Now, what I want to do is debunk a few common myths that tend to be used as fundamental arguments by those representing the corporations in opposition of this legislation. Myth number one is that businesses will leave Rhode Island. There are states that have banned the practice of payday lending altogether, and believe it or not, life goes on there. And if you're looking at Arizona, Arkansas, Connecticut, Georgia, Maryland, Massachusetts, New Jersey, New York, Pennsylvania, North Carolina, and Vermont, and West Virginia, I don't want to forget West Virginia, other states have curbed lending in various ways, but they've abolished it altogether. And if we look at Connecticut and Massachusetts right now, they're doing okay. Another myth is the myth of job loss. That's always what I like to refer to as the hostage myth. It's, well, we know you're hurting for jobs in Rhode Island, so maybe we'll just take them away if you don't give us what we want. Oregon, isn't the best in terms of what it's done, but they capped their APR at 100%, and their business is still doing very, very well. Massachusetts, Connecticut, they've banned the practice altogether, and they're still creating jobs. Economic growth requires purchasing power. If working Rhode Islanders are caught in a long cycle of revolving loans and rollover fees that is dictated by U.S. law to be represented by APR, notwithstanding the various euphemisms used in the industry, that money is not being reinvested in the Rhode Island economy and used to sustain and grow the jobs here in our own state. Furthermore, unless this has changed in the past 2 years, the average income for a storefront payday loan employee is approximately $27,000 annually. Now, the third myth that I want to debunk is that people want this service. Otherwise, why would they use it? A recent Pew Research Center poll of over 33,000 people concluded that approximately 74% of those polled did not support the industry in its current form. Now, people will use short-term loans out of necessity. Rhode Island citizens will need, obviously, to face the unexpected financial burdens that arise, and short-term loans are a resource. However, it is a responsibility to prevent the exploitation of those in need by corporations. A bill that caps at 36% APR interest and eliminates language allowing short-term loan providers to use rollover fees, revolving loans, and churning as a means by which to evade such a statute and standard, followed by all other financial lending institutions. That seems to me to be kind of a no-brainer. I don't know if you're familiar with the term churning. It's probably are. You look like you're pretty familiar with it, so I won't go into the definition of churning. But you know, this bill, both of these bills would protect Rhode Island's financial vulnerable citizens, and they keep Rhode Island dollars in Rhode Islanders' pockets and flowing to Rhode Island businesses. This would also work well as a demonstration of the financial empowerment initiative overseen by our Office of the General Treasurer and supported by our governor. And I have very little doubt in my mind that all of the members of this committee are dedicated to the financial empowerment of the citizens of the state of Rhode Island. So I urge you to break with the annual and unfortunate decision to pass on this issue in past years and support both of these bills. And I'd be happy to answer any questions.
Thank you, Jonathan. I ask if anyone has written testimony, please summarize it for us. It is getting late, and we have 7 more bills on our agenda. Randall?
Thank you, Madam Chair and members of the committee. I am also here to support both bills, especially since they're identical. I want to draw attention, since the topic came up too, the definition of rollover, which is in our current general laws, section 19-14.4-5.1 C. The definition of rollover is very narrow. Something counts as a rollover only if the check cashing business holds on to a check longer than they were originally intended to and refuses to cash it. So with that very narrow definition of rollover, yes, of course, they don't do rollovers. But as they admitted, they do sometimes have people continuing in debt over an extended period, longer than the initial period of the loan, or people coming into and out of debt for a considerable period of time. There's a lot of very obvious economic holes in the argument for payday lending, but let me just draw attention to one thing. They say they cannot stay in business if they are forced to charge a lower interest rate than the current amount, which is 10% face value, or what's said to be 260% APR. Think about that seriously from an entrepreneur's point of view. You're an entrepreneur, and the business you're backing says, we can't stay in business with less than a 260% return. That's ridiculous. With 260% APR, you're making money hand over fist. No matter what your expenses are, you should be able to stay in business with that much. Actually, it's more than 260%. My calculations should say might be a little over 260% if you don't do compound interest, but with compound interest, which is the definition of APR, with compound interest, it's going to be even considerably more than 260%. Because 26 two-week periods in the year, 260% without compound interest. But leave that aside. So there's a number. One important point that was very telling in the testimony is that a number of these customers of check cashing businesses actually have credit cards. That was admitted by the people who operate these businesses. So these are not people without access to credit. They have access to credit. But what the borrowers are doing is they are borrowing money at a far higher APR than their credit card in order to pay off their credit card. Which is a very unsound financial practice. Nobody would possibly want to do that if they're making rational decisions. It is not a sensible way to manage money at all. And I want to draw attention to this. Also, their business model is different from the credit card company because the credit card company charges a pretty moderate interest rate, but you have to cut them a check for them to collect. With a check cashing place, they charge a far higher interest rate, and you do not have to make that decision to cut a check because they are already in possession of the check. So they have less risk because they can simply deposit that check. They don't have to wait for you to write the check. So they are charging a far higher interest rate for less risk. Which is completely unsound and undeserved. And as a result, I kind of believe them sometimes when they say that they don't need to, that some of their customers don't keep repeatedly being in debt one time after another to them because they don't have to, because they are the ones who are assured of payment. Their customers may be in debt to a credit card company, to a car payments, and to them, but because the check cashing place actually possesses the check cashing place is the one that's going to get paid when all these other debts are not paid. So they extract the high interest rate from people who cannot afford to pay it, and when everything goes to hell and this person is going into bankruptcy, then it's the other creditors who are left holding the bag. So so that's their business model, and I know they say they check if people can afford their loan, but notice they were saying only their loan, not whether they were not checking whether the borrowers can afford their total debt burden, because they are the ones who are most assured of payment, so they don't need to worry about the rest of the borrower's debt burden. They charge 260%, and even if they didn't have the check in possession, the bankruptcy laws since the early 2000s are very favorable to creditors. They should be assured of making that money back. So I can't believe that they would not be profitable if the interest rate were lowered. If they are sincere in saying they'd get out of the state if they didn't do this, that's just because they don't want the threat of a good example. I'm sure they do check how much their borrowers are able to repay. They may check who else in the borrower's family is able to repay. I'm not sure what their definition of household income is when they say that their median household income is $56,000. The correct definition of household income is people who live in the same place, but I'm not sure they actually check for that. They may have just included every source of income that the borrower had or claimed to have. So I'm not sure how well verified that is. But let's just the fundamental thing here is responsible lending does not allow borrowers to take out every loan that they want to take. That's the fundamental of responsible thing about responsible lending. And it's really troubling when this industry keeps saying, well, we're doing a favor for people because we're letting them take out every loan they want to take. That's not good. The big truth that's not being faced here is that people, if you don't have this kind of high interest rate product available, some people will choose not to take out the loans, and they will actually be better off for not taking out these loans. And that's the reason why we have regulation on the interest rates here.
Could you sum up, Randall?
Yes. Okay. I do want to say, all right, there is one important economic argument that I feel I should give because this is the Finance Committee. The truth about lending is that at any socioeconomic level, there's a certain percentage of people who will borrow the amount that they can afford to repay. Not everybody does that, but a certain percentage of people will borrow the amount that they can afford to repay. And if they're charged a 1% interest rate, then that's okay. If they're charged a 1% interest rate or a 10% interest rate, it's okay if they miscalculate a little, because even if they miscalculate and make and are not able to pay, then the total debt doesn't pile up that fast. But if you're borrowing something pretty close to the amount you can afford to repay, and the interest rate you're being charged is 260% APR or more, then if you make even one error, if you make even one miscalculation about what you can afford to repay, that's going to pile up so fast. So that's why we have a statutory limit on the interest rate. You can't allow the public to borrow at an interest rate of 260%, or that percentage of people who borrow something close to the amount that they're going to repay are going to get into this trap. They're going to be economically unproductive, and their economic earnings are going to be lost to the state. So
Okay,
that's the case.
Thank you, Randall. Do we have any questions of this panel? No? All right.
There are some other important points, but I guess I will have to skip them. Okay.
If you could give them in writing, that would be appreciated. Thank you.
Thank you.
I'd like to ask Martha Yeager and Sean Selleck.
You're no longer here, but written testimony was submitted.
To the clerk. All right, thank you.